my name is Marilena and I will be your hostess for today. Together with me I have Peter, our senior market analyst at IronFX. Hello Peter.
Hello.
Thank you for joining us today as we're looking at the fundamentals that are driving the markets currently. I guess all the eyes of the market are on the Fed's interest rate decision, right?
Definitely. Today is Fed day. We get Fed's interest rate decision. The bank is widely expected to hike rates by 75 basis points. It should be noted that about not even a week ago, practically the market expectations were for 50 basis points rate hike, which was lower. But the acceleration of the US CPI rates for May in conjunction with the rather solid employment data for the same month tended to provide the grounds for the market's expectations to actually rise and for the bank to need to take a more decisive step in order to curb inflationary pressures in the US economy. We would like to note, though, that it's not only the interest level as such. The market will be expecting in the bank's forward guidance also for the bank to actually foreshadow more rate hikes to come, a decisive, a hawkish stance, and I would also place considerable weight on the dot plot, the new dot plot, which is going to be telling us more or less where Fed policymakers are expecting rates to land, and also the economic projections are going to be crucial. Last but not least, I would be highlighting Fed Chairman Powell's press conference. Fed Chairman Powell has been well known to create wide volatility in the markets with his press conferences, so I wouldn't be surprised to see some market sentiment turnover in the press conference as such, which is to follow the decision, the release, for about half an hour. Other than that, volatility is expected to remain rather high, so a cautious approach would be advisable.
Okay, and how is the USD expected to react?
Well, that depends. The market has priced in substantially the possibility of the bank hiking rates by 75 basis points. It expects definitely a hawkish tone in the forward guidance. So practically we should expect some support for the US dollar, which may be pushed to new record highs. That's the one scenario. However, should the bank for any given reason actually fail the markets, disappoint the markets, we may see the US dollar tumbling. However, we expect that there would be wider repercussions beyond the FX market from the release.
Okay, and how about the US stock markets?
Well, US stock markets have been dropping. Actually, they have entered the bear market. And that's also an issue which should be taken notice of. Definitely the tightening of the Fed's monetary policy tends to drain the market out of liquidity, providing less chances for profitability and investment. So overall, should the market actually hike rates by 75 basis points, the triple rate hike, and at the same time sound hawkish, that could cause US stock markets to drop even lower. So overall, once again, that would be advising cautious for equity markets traders as well.
And gold?
Well, gold initially at the release of the US CPI rates on Friday got some support. And that was understandable because gold is also a hedging instrument against inflation. But on Monday, US yields tended to rise substantially. The US dollar continued to strengthen. And that tended to weigh on gold's price. So we would expect that probably should the US dollar get some considerable support from the release of the Fed's interest rate decision later today, we may see gold's prices sinking, or I wouldn't say sinking, no, that's too much, lowering even further.
And what's in the calendar today?
Well, for the calendar today, we have a number of financial releases. We would make a start with the common currency. We have the industrial production growth rate of the Eurozone, which is expected to accelerate. And not only expected to accelerate, it's expected to get out of the negatives, show growth once again, and that could provide some support for the euro as it would more or less provide more confidence to your traders. A second issue, which would be a second release, which would be also notable, would be Canada's house starts. And the main reason why is because Canada has a red hot housing market. It was characteristic how Bank of Canada in the past week actually highlighted the housing market and that it may have been over the edge, it's in a bubble. And that more or less tends to increase the focus exactly on the release today. The house starts number is expected to drop somewhat, and that could practically weaken the CAD a little bit. Another release which would be interesting is from the US. It's the US retail sales growth rate. It's expected to decelerate, and actually quite substantially. And under any other given circumstances, I would expect the US dollar to weaken from a possible deceleration of the retail sales, as that would imply practically less consumption, thus a lower contribution of consumers towards the recovery of the US economy. And that, though, today may be overshadowed by the Fed's interest rate decision, most probably will be overshadowed. So that may pass rather unnoticed, but nevertheless, on a macroeconomic level, that would be important to note how retail sales in the US are actually behaving. I would be also noting the EIA crude oil inventories figure. It's expected to reverse the prior buildup of oil inventories in the US and show a drawdown, which, if it actually does, may imply a tightening of the US oil market due to increased demand, and in which case we may see oil prices getting some support. Jumping now to tomorrow's Asian session, I would make a start with New Zealand's GDP growth rate. It's expected to decelerate substantially, and if actually so, may weaken the Kiwi, as it would imply practically that the New Zealand economy slowed down on its expansion. And that could have also an effect on RBNZ's, the Reserve Bank of New Zealand, interest rate policy. I wouldn't say lower it, but still may have second thoughts about an aggressive hiking path. We move on, and we have also from Australia the employment data for May. Now we should note that the Aussie got some support during today's Asian session. That support may have been resulted, at least partially, also from the robust Chinese industrial data. Note that the industrial production growth rate of China improved substantially, actually more than market expectations, and that tends to be good news for Australian exporters of raw materials because they have a high amount of exports from Australia to China, and they're feeding the manufacturing sector of China. And other than that, I would be highlighting also from Australia RBA's monetary statement release. Mind you, though, that the employment data for Australia are expected to show a tick down of the unemployment rate from 3.9 to 3.8, while at the same time the employment change figure is expected to rise from 4K and reach 25K. Now, the release, should the actual rates and figures meet the respective forecasts, we may see the Aussie gaining, and that would be a result practically on two reasons. The first is the actual tightening of the Australian employment market as such. The second issue would be practically RBA's rate hiking path. Why? Because RBA had directly linked the rate hiking path in the coming meetings with incoming data from the labor market inflation. So practically, should the labor market of Australia tighten, that would be the first green light for the hiking path to continue.
Interesting. What would you single out from today's releases?
Well, definitely, we have mentioned before, the Fed's interest rate decision would be the most interesting and the most market-moving release today. Other than that, though, I would be noting also Australia's employment data. That would be, in my opinion, the most important macroeconomic release, and it's expected to influence also, as we have mentioned, RBA's interest rate decision. An RBA which, mind you, has started to hike rates at a faster pace than what the market had expected. So I think that could be a turning point. But if the release comes out as expected, i.e. showing a tightening of the Australian employment market, most probably that would be a continuation or provide a continuation for RBA's rate hiking path.
Okay, give us your final comments.
Well, as a final comment, I would be more or less advising caution when trading today. There is lots of turbulence in the markets for the past 3 days, and the market has priced in substantially the expectations for a 75 basis points rate hike from the Fed. It was characteristic that the US dollar was on a continuous rise for the past 3 days since Friday afternoon, while US stock markets were dropping. So I would expect that the turbulence which will be created by the Fed's interest rate decision later in the American session could have ripple effects beyond the FX market and actually create volatility for stock markets and gold prices as well. Possibly we may see US yields also being highly affected.
Great. Thank you, Peter.
Thank you.
And everyone for watching. Join us after a short break for technical analysis with Peter Yosif.
So welcome everybody for the technical analysis part of today's presentation. My name is Peter Yosif, Senior Market Analyst at IronFX. What we have in front of us actually on your screen would be the 4-hour USD index chart. Note how practically the USD index was allowed to continue to rise, actually aiming for the 105 resistance line, which was last tested around the mid-12th to 13th of May. Note where we're talking here about 1, 2, 3, 4, 5, 6, 7, 8, 9 consecutive green candlesticks, one even with a positive gap. We tend to maintain a bullish outlook for the index, especially given the Fed's interest rate decision. Should the bulls actually maintain control over the index, we would expect the index to actually break the 105 resistance line and start aiming for the 106. If I'm correct, that was last tested, but they have a check. Nope. We're here. And note at the same time, though, the RSI indicator, which is below our 4-hour chart, it has surpassed the reading of 70. Once again, reminding us of the bull's dominance, but at the same time, sending a signal that the index has reached probably overbought levels and may be ripe for a correction lower. On the flip side, once again, I would like to advise some caution here, as practically the release of the Fed's interest rate decision, despite expected to excite traders and provide some support for the US dollar with its triple rate hike, may also disappoint traders. Should the market's expectations not be fulfilled, and there is a possible risk factor here, we may see the US dollar tumbling. And in such a case, we may see the US dollar actually relenting all the ground it had gained after the acceleration of the US CPI rates last Friday afternoon. In such a case, I would expect the index to break the pre-mentioned upward trend line, break the 103.95, start aiming, if not breaking, actually breaking the 103.25 mid-level, possibly testing the 102.75 support line, if not breaking it as well. It's a very steep drop, I know it, but the Fed's interest rate decision is going to be under the magnifying loop of the traders. So we may see substantial volatility intensifying over the next, I wouldn't say just 12 hours. It could last a little bit longer. Let me correct this one, the upward trend line, because it's actually steeper and should be reflected. So I would expect the aftermath of the interest rate decision, should the decision as such disappoint traders in any way, we may see the aftershock being expected also to endure throughout the American session, maybe even into the Asian session tomorrow. Let's have a look at Euro USD. Note how the US dollar is still rising, no red candlesticks. And if we turn now to the Euro USDs for our chart, note the wide rise of the common currency practically in today's European session as it broke just above the 1.0480. However, as the US dollar still continues to strengthen, we would expect Euro USD to correct a little bit lower, possibly below the 1.0480. At the same time, I would like to highlight a small catch here for Euro USD. On the Euro side, we have a fundamental which may be decisive for the direction of the pair. Now, the news are that the ECB is going to be having an extraordinary meeting, the ECB Council, and it's going to be discussing practically the repercussions of its interest rate decision. Remember, on Thursday when we had the interest rate decision of the ECB, there were some substantial worries from Euro traders as practically the rate hikes which were foreshadowed for July and September may also imply fragmentation of the interest cost which is being paid by member states of the Eurozone. Say, for example, fragmentation would imply that Italy and Greece may be paying a higher interest rate for the loans, which mind you are heavily indebted, in relation to, say, for example, Germany, which may be paying a lower rate. And the ECB wants eagerly to avoid such a scenario, but in ECB President Lagarde's press conference, Lagarde actually did not mention any specific way which could allow the bank to avoid fragmentation. Hence, there was a substantial doubt among investors. And I would dare to say that that tended actually to weigh on the euro at some point. It would be characteristic actually that if we see the downward movement, we'll see that the downward movement actually began on the 9th of June, which was prior to the release of the US CPI rate. So practically the weakening of Euro USD started not with the release of the CPI rates and the strengthening of the US dollar, but also with the weakening of the euro by ECB's interest rate decision. Now, should the bank actually announce some hard measures which may convince the market that the bank will be able to avoid a fragmentation, that could provide some substantial support for the euro. Other than that, I would expect the correction higher here to be treated as a correction. And most probably the pair will continue to move lower should the Fed's interest rate decision actually excite USD traders. Let's have a look now at GBP USD. GBP USD, which had a similar movement. It was quite interesting as well. Let me make some readjustments here. There we go. Note that cable seems to be recovering somewhat like the euro in today's European session. Once again, though, we see the slight support which cable got being temporary. I would like to see higher truths and higher peaks in order to switch my bias for a sideways movement here. It should be noted that the fundamentals regarding cable are still on the negative side for the pound, given that the tensions with the EU seem to be escalating. The UK-EU relationship tensions seem to be escalating as the UK seems to be about to move forward with the overriding of the Northern Ireland Protocol, and actually the possibility of a trade war between the EU and the UK. It's the last thing that the UK economy actually needs right now. Note that the GDP rates for April on Monday showed that the UK economy actually shrunk even further. At the same time, the employment data, I wouldn't say were disappointing, but still there seem to be some cracks in the tightness of the UK employment market. So I'm a bit starting to get a little bit worried here. Thus, I would expect a correction lower once again, below the 1.2070. But mind you, that's all up to whether the Fed's going to be actually delivering on the market's hawkish expectations. Should the bears take over, I would expect the pair to clearly break the 1.2070. Aim, if not break, the 1.1817 and start aiming for the 1.1637. i.e., note that the pair was just about to break a reading of 30 in the RSI indicator below a 4-hour chart, which reflects practically the correction higher. On the flip side, though, being just above 30 with the RSI indicator doesn't mean that the pair is out of the woods and that the bears have left the scene. On the contrary, I would be considering that the bears are still here. I would like to see the RSI indicator actually reaching or surpassing the reading of 50 before easing somewhat on my worries here. Nevertheless, should the bulls take over, we would highlight the 1.2210 as the next possible resistance line, given that the level had provided some resistance that was yesterday, if I'm correct. Yep, yesterday. Higher than that would be the 1.2330, which was a price support line. And even higher, we have the 1.2470. Let's move on to USD-JPY. USD-JPY, which moved lower. Let me make some readjustments here. Now that's better. What do we see here is practically the 135 being breached. That should be around the Asian session today. Let me have a look. Yeah, actually that was during the later session yesterday. And during today's Asian session, the pair corrected lower and re-entered its path sideways movement between the 135 and the 134. But there's a big question on whether we have here higher highs and higher lows. So there may be an upward movement. Let's have a look. Yeah, could be. There's some slight upward movement. I would like to see that being broken. Let's see if this is a channel. No. Yeah, that could be a channel. Seems about so. Let's make sure of it. Yep. This is a channel, people. So there may be an upward movement here, which may have passed a little bit under the radar. On the flip side, though, we have to note that the RSI indicator seems to be moving downwards. So that would be an issue. And in such a case, usually the RSI indicator tends to have that, especially should the indicator drop below 50 and start aiming actively towards 30. That would imply a correction lower, substantial correction lower for the pair. I would expect it in such a case to break the 134 and start aiming for the 133. Maybe even break the S2 and start aiming for the 131.35, which was a prior resistance line and has now been turned to support as the price action is above it. On the flip side, should the upward movement be continued, let me adjust a little bit the low boundary of the channel. Yeah, that should be better. Some false breaks, but okay. Now, we would expect initially the price action to bounce on the lower boundary of the upward channel, break the 135, start to actively aiming for the 136.50, yet as we meet the upper boundary of the upward channel, once again correct lower and start aiming for the 136.50 once again at a later stage. It's going to be interesting to see whether the channel will be verified in today's meeting. Note that, once again, the Fed's interest rate decision could substantially intensify the upward movement of USD/JPY should the Fed deliver hawkish interest rate decision forward guidance. Let's have a look at USD CAD. We'll have to readjust the levels here a little bit. Oh yeah, definitely. All prior resistance lines now become support lines. I'll put a new one here. There we go. And we have new support lines being placed. Sorry, resistance lines being placed here. 1.2970. Higher than that would be the $1.3045. Excuse me. But even higher. Could go a little bit higher. Let's have a look. Let's go a little bit hunting here. There we go. Actually, that's been confirmed. That's interesting. Okay, so this is going to be rising up to the occasion, reaching 1.30 to 120 in a bright red color. It is. So we have the 1.3120, the 1.3045, the 1.2970, the 1.2890 as the first support line, the 1.2805, and the 1.2755. Let's lock this in. It is. So we have USD CAD moving in a clear upward motion, which has just been broken after peaking at 1.2970. Hence, we tend to switch our bullish outlook in favor of a bias for sideways movement initially between the 1.2970 and 2890. I would like to note, though, that should the bulls maintain control, or regain control to be exact, that could imply practically that the USD CAD would be rising, breaking the 1.2970, start aiming for the 1.3045. Somewhere here. On the flip side, once again, should the bears take over, I would expect the pair to break below the 1.2890 and start aiming for the 1.2805. Note the RSI indicator has surpassed the reading of 70, actually implying that the pair is overbought, signaling that a correction lower is possible. It's actually happening during today's European session, yet the indicator is still above 70, so there's still room for a correction to go even lower, possibly start aiming for the 1.2890 before stabilizing somewhat. Okay, let's have a look at the final pair for today. That would be AUD-USD. Let's readjust the labels. So we have the USD index, sorry, AUD-USD correcting once again. The US dollar is weakening. We must have a mistake here at the USD index M2. Let's have a look here. My goodness, this has changed. Definitely. We'll have to correct that later on. Okay, let's have a look at the Aussie again. So we see that there is a correction as the pair has reversed its downward motion, broken the downward trend line, and is currently aiming for the 0.6950 support line, resistance line. For the time being, we switch our bearish outlook in favor of a sideways movement initially. Once again, though, we may see the Fed's interest rate decision actually providing further support for the US dollar, should it excite USD traders, in which case we may see AUD-USD restarting its drop lower, breaking the 0.6825, which is the first support line, which provides support here, moving lower to the 0.6730. And in an extreme bearish scenario, we would expect the price action to start aiming for 0.6620. To the upside, and should the Fed's interest rate decision actually disappoint traders, we may see the AUD-USD breaking above the 0.6950, which provides resistance here, support here, and start aiming for the 0.7035. Higher than that, we also note the 0.7155. Quite interesting chart though. We have time for a small peek. Let's have a small peek at gold as well. Oh yeah. Once again, the downward trend line, which has guided gold's price practically $60 lower, has been broken. And now the price of gold is rising, aiming for the 1836. Definitely another sign of the weakening of the US dollar. We tend to maintain a bias for a sideways motion initially between the 1836 and the 1807. However, that will widely depend on the Fed's interest rate decision later today once again. Should the bears regain control, say for example if the US dollar restarts strengthening once again, we may see gold's price reversing direction, breaking the 1807, and start aiming for 1787, which provided support here, the 16th of May, and even lower we note the 17.60. To the upside, and should the Fed's interest rate decision actually disappoint traders, we may see gold's price breaking the 1836 and start aiming for the 18.70. Also, note that the market reaction, in case the Fed's interest rate decision actually disappoints traders, may be disproportionately larger than the market reaction should the Fed interest rate decision actually go as expected by the market sentiment and follow through, deliver on the market's expectations. So there would be a higher risk on the downside here. And I don't mean for gold, I mean downside for the Fed's interest rate decision. Be careful, stay on your guards, keep your stop losses. From all of us here at IronFX, best wishes for solid trading.
I'm Christina, and I would like to share with you some trading tips with you today. When the markets give you money, you better take it, because you may not get that opportunity again. Some traders take the market for granted, like some believe they actually know where the market is heading. That could be possible for the long run, but for a day trader, you don't know what's going to happen. You don't know. So you have to take everything you can. Some opportunities that come to you must be dealt with accordingly. What I mean is, when you come across a high conviction trade, you have to step on it and you have to go all in, and this requires courage. These opportunities are rare and you have to take full advantage of them to be successful. Excitement, euphoria, panic, or fear should not exist in traders' calculations, and especially when actually trading. Yet we have to acknowledge and embrace our human nature and that emotions are part of the game. We have to accept that fear is there to guard us from possible mistakes, for example, yet you have to overcome them and set them under control to trade. That is why traders are always advised to begin with small amounts. By reducing your risk, you can be calmer to enhance your performance and improve your confidence. A logical approach and less emotional intensity are the best forex trading tips necessary to a successful career.
Everyone, my name is Emily and welcome to our daily commentary. The USD continued to strengthen against a number of its counterparts yesterday, and the drop of cable was characteristic. The market places its focus on the release of the Fed's interest rate decision, and given the acceleration of the US CPI rates, along with the solid employment data, both being for May, the bank is widely expected to hike rates by 75 basis points today. Today we'll be also getting the new dot plot, and investors are expected to be eager to learn on where the rates are about to land as per the Fed policymakers. Also, new projections are to be released which would show the bank's thoughts about the possibility of a slowdown of the US economy or even a recession, as well as how inflation is expected to behave. Overall, should the bank actually proceed with a triple rate hike as expected and beyond the new dot plot and economic projections, the next point of interest is to be the Fed's forward guidance. Should the bank actually sound confident and hawkish, foreshadowing more interest rate hikes to come, we may see the USD getting some substantial support, while anything less than what has been described above could weaken the greenback. Also, please bear in mind that the Fed Chairman Powell is to deliver a press conference half an hour later and could increase the volatility of the USD. Overall, the event to approach cautiously by traders, as it may create substantial volatility not only for the USD but also have ripple effects for gold's price as well as for US stock markets. GBP against USD continued to drop at some point, even breaking the 1.2015 level, yet seems to be revisiting. We tend to maintain a bearish outlook for the pair as long as it remains below the downward trend line, which had been guiding cable since the 9th of June. Please note, through the RSI indicator remains below the reading of 30, which could imply that the pair is at oversold levels and may be ripe for a correction higher. Should the selling interest be maintained as expected, we may see cable breaking clearly 1.2015 and take aim, if not breach, the 1.1880 support level. Should the pair find fresh buying orders along its path, we may see the pair aiming, if not breaking, the 1.2016 resistance line. The Aussie continued to weaken against the USD yesterday, yet seems to be staging a slight rebound during today's Asian session. may be also supported somewhat by the robust industrial production data for May of China. Nevertheless, we tend to maintain our worries for any lockdown measures could be imposed in China as they may slow down production growth. Tomorrow during the Asian session, we note the release of Australia's employment data for May, and we note that the unemployment rate is expected to tick down to 3.8%, while at the same time, the employment change figure is expected to rise by 25,000 if compared to April's 4,000. The release could provide some support for the Aussie, as should the actual rates and figures meet the respective forecast, the data would align, pointing towards a tightening of the Australian employment market. Exactly such a tightening could arrow RBA to continue on its rate hiking path, given that the bank, in its latest interest rate decision, conditioned any future rate hikes with incoming data about employment market and inflation. It should be noted that tomorrow, during the Asian session, RBA is to release its monetary policy statement as well. OD against USD continued to drop yesterday, breaking the 0.6910 support line, now turned to resistance. Please note that the pair is currently testing the downward trend line, incepted since the 9th of June, and should the pre-mentioned downward trend line be clearly broken, we would switch our bearish outlook in favor of a bias for a sideways motion initially. Should the bears maintain control over the pair, we may see it breaking the 0.6825 support line and aim for the 0.6750 level. Should the bulls take over, we may see the UD and against USD breaking the 0.6910 level and take aim of the 0.6970 resistance line. We've been hearing lately that the US stock markets have entered a bear market. But what is actually a bear market? As per Investopedia, a bear market is when a market experiences prolonged price declines and typically describes a condition in which security prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Bear markets are often associated with declines in an overall market or index like the SP 500, but individual securities or commodities can also be considered to be in a bear market if they experience a decline of 20% or more over a sustained period of time, typically 2 months or more. Bear markets also may accompany general economic downturns, such as a recession. bear markets may be contrasted with upward trending bull markets. So what should an investor do? Should she close all his long positions in US stocks? Well, that is an option, yet at the same time, that would imply that the trader will lock in any losses occurred so far and miss from a possible correction higher of the US stock markets. On the flip side, though, a bear market may last for months, and it's characteristic that the longest bear market recorded took 61 months to end, that being back in 1942. The last one occurred about 2 years ago with the appearance of COVID. That may imply that in the long term, a trader may not be able to afford defending his positions until the bear market turns bullish once again. Also, as mentioned before, the market may temporarily correct higher, but just enough for the trader to regain some of the losses or even make a small gain. It's a decision that each trader will have to weigh for herself and take the necessary decisions. On the other hand, a trader may always initiate short positions which could make gains should the market continue their downtrend. But how do we know that a bear market has ended and has turned bullish once again and prices of shares are on the rise? Well, typically investors look for a 20% gain from a low point as well as sustained gains with the price action marking consistent higher peaks and higher troughs over a substantial period. Thank you.